This is 3Q, I'm Sarah McDonald. When Lehman Brothers collapsed, it didn't really register with most of us. Australia's escaped the worst of the global financial crisis, but its impact can't be ignored in one area: superannuation. Over $75 billion was wiped off our super share value, and it'll be another few years before savings are back to their pre-GFC levels. So today we ask super, what comes after the GFC? Dr. John Glass is Media Super's Chief Investment Officer. Hello.
Hello, Sarah.
So how much do we lose each?
It's hard to quantify at the individual level. I find it better to look at investment markets, which is the place from which we derive the investment returns that we pass on to our members. And the truth is, in the last 4 to 5 years, all markets have been shaken. The pillars have really jutted and shuttered. But interestingly, the American stock market is almost back to where it was prior to the GFC, not the same for the Australian share market.
You've got a graph here that explains what happened to our super. Can you talk us through it?
Sure. There are two messages in this graph, one short-term, one long-term. The long-term message, which is the one I'd like to emphasise, is that returns over suitably long periods of time for the balanced option, which is where most of our members have their money, has been above 8% per annum. Importantly, that must be viewed in the context of inflation. Inflation over that period has been a little bit over 2%. 8 minus 2 is 6. We call that technically a 6% real return. That is a fabulous outcome over the long run. Notwithstanding, those paddle pop sticks, which seem to go up and down, show how volatile, how difficult things can be in the short term. And so we always like to emphasise the long-term nature of these investment strategies. It's called the miracle of compound interest, which even the great Albert Einstein referred to as the 8th or perhaps the 9th wonder of the world. And it is a very powerful tool for building long-term
So the interest we earn goes back into our investments and that helps it rise.
Yeah.
So when do you think we'll get back to pre-GFC levels?
It's important when I think about markets to separate what can't be known from what is merely uncertain. And I think there are things that can't be known. How will the European crisis resolve? I don't think can be known. What will be the fate of the euro? I don't think can be known. But in our world, working inside Media Super as executives looking after our members' money, we like to think about what is uncertain and we try to convert that into what is likely. And that's a much safer place in which to think.
So in such uncertain times, what are you doing to protect super investment?
We're looking for strategies which, and I'm sorry to use jargon, deliver less volatility. But perhaps to make it more visual, we're looking to push the swing so it doesn't go up and down quite so fast that you get giddy. And we've got some strategies which access conventional markets but do not produce such volatile outcomes as simply owning shares or bonds or property has been prone to over the last few years.
What about new opportunities? I know that Al Gore's been here, and are you investing in new technologies that he suggests?
One of the big initiatives in the last few years has been the UNPRI, a 5-letter acronym, the United Nations Principles of Responsible Investing. This is an initiative which tries to gather together all the superannuation and pension funds worldwide into a collective where they start to think long and hard about the future of their assets with regard to the environment, with regard to social changes, and with regard to what we call corporate governance. We think this will become increasingly important. We in Media Super are giving more and more attention to these matters as time goes forward. And it's a matter of being vigilant. It's a matter of looking for opportunities which can exploit the changes in the environment. But there's a negative side. It's a matter of trying to avoid those investments which will suffer with the environmental changes going
so
forward.
what keeps you awake at night, John?
Many things. I think first and foremost about risk in the portfolio. Now, risk is one of the biggest, most overused terms. I like to think that risk for a member is that risk of not achieving the long-term goals of the fund. I referred before to that greater than 8% return over long periods of time with inflation much less. That's the kind of outcome we want. Risk to me is not being able to achieve that outcome, notwithstanding the ups and downs of markets over a long period of time.
How have the people gone who've made their own choice about their investment? So that those that have said, I want it in certain property or shares or emerging technologies, how have they fared compared to the people who have just gone with the fund's advice and diversification?
It's worth bearing in mind that the super system offers member investment choice, and to play into that we offer 10 options to our members. Most member money is in the default balanced option, but there are share options and bond options. I think, unfortunately, the empirical record shows that when the average member switches in and out of options, they tend to get their timing wrong. They tend to buy and sell at the wrong time, not the right time. It turns out to be incredibly difficult to time markets.
So the lazy amongst us that left it to you have benefited.
Thank you. We'd like to think so.
All right, let's open it up to our panel now. Tony Ma, super for your members is obviously important. What impact has it had for those who are close to retirement, the GFC? I know one guy who's had to go back down the mine at the age of 65. Is that common?
Well, it's increasingly a problem, and you're talking about people who are on good wages and are what the super funds called high net worth individuals. So they go out with a decent super amount by and large, and it's the impact on the earnings of the funds has changed people's retirement plans, and there are many examples. It's becoming increasingly common.
Jeff, what about your members that perhaps don't even earn as much? Then they didn't have as much super to start with, and when the GFC hit, they must have been hurt even more.
There's no doubt that it's had an impact, and I have to declare an interest here, Sarah. I'm a director of Australian Super, which is the largest fund. I think the important thing is the not-for-profit model that we have of industry funds, which of course is under attack. Of course, we're all susceptible to what happens in the international markets. As has been said, some of those things you can't control and you can't predict. But we do have a model here which is based upon benefit to members as against benefit to or profit to a financial institution, and I think it's a model that's worked well. I think it's important to defend it, and as I say, it is under attack. There is no doubt that the Liberal Party and some allies in financial institutions are about increasing the profit for the large financial institutions. On the other hand, industry funds are about benefit to members, and you can see over time that benefit has been there.
Well, they're kind of under attack because people like you are on the board, isn't it? That's one of the reasons in terms of that.
That may be the case, but I think it's also that there is significant money to be made here, and the large financial institutions and the banks and so on, of course, want their cut of it and want to increase their cut of it. On the other hand, the model has actually shown that it's delivered benefits over time to members, and in the end, that's what people should look at.
Tony, do your members want to see their super invested back into the mining industry that is currently doing so well?
Well, there's no shortage of investors for the mining industry, so that's not so much an issue, but we would like to see more investment in infrastructure, including mining-related infrastructure. And I think the super funds are an untapped resource under the current policy settings, and there needs to be more work done by the government and the super industry about how to unlock that potential, because we've only got three sources of funding, I think, the government purse, the MAC banks of the world, and super funds. So, I think we've got to get it above the 5% that super funds currently invest in infrastructure.
Dr. Glass, it was interesting that so much of the GFC is about fear and emotion in the market. How much does that play a part of super?
I think anywhere that people invest, it is the case that psychology comes into play. So, for example, the behavioural psychologists have been telling us recently that people, individuals as a rule, hate losing money twice as much as they enjoy winning money with the opposite side.
I could have told you that without doing my PhD, but yeah.
But now
just an undergraduate degree in psychology. Yeah.
Seems to be the case. People have a lot of biases. They are too easily influenced by recent events. They don't give enough time and consideration to considering the long term and the true lessons of history, because it turns out when you pick up the shovel and dig the turf, there is a lot to be learned from history, notwithstanding the fact that markets change all the time. In many ways, they haven't changed at all. And reading books that analyse the Wall Street crash of 1929 tell stories that we have heard again in 2008.
Mm-hmm. All right, if you'd like to pitch in with your views, just check out the 3Q hashtag on Twitter or go to the website for Essential Vision. You're watching 3Q.